Hello everyone, and welcome to lesson 1.8. In today's lesson, we're going to be covering how you find stocks to trade and how you prepare for your morning. This is a critical skill set for traders to learn because if you're trading poor tickers or tickers that just don't trade well or are very choppy overall, you're going to ruin your day before it's even begun. So I'll help you avoid that pitfall in this lesson. Let's get into it. Okay, so in today's lesson, we're going to start off by just looking at an overview of what a good pre-market routine will look like. We'll then talk about pre-filtering your list of stocks that you could even potentially pick from in the morning, and then we'll get into different ways that you can choose stocks for that individual day of trading. Finally, we'll talk about planning your trade and trading your plan, which is a critical portion of success in day trading. Okay, so we'll start out today by just giving you an overview of kind of what a good morning routine will look like. With a morning routine, there are kind of two key elements. And these can be different for every single trader in terms of what they actually look like, but they should check both of these boxes. First, your morning routine should put you in the zone. If you listen to a lot of literature around psychology, particularly around performance athletes, they'll talk about something called the flow state. And getting into this flow state, you can do it many different ways. Maybe it's a song that really hypes you up, or maybe it's a set of affirmations that you've pre-recorded and you're listening back to. Whatever it is, getting into this flow state is critically important because you're walking out into an arena that is the equivalent of a professional athlete, right? You're competing against large banks, you're competing against more experienced retail traders, so you really do need to make sure that your routine puts you in the zone and you're ready to step into the market when the bell rings. The second element of your morning routine is that it should be repeatable and easy to maintain. If you have kids or if you have a dog that you have to walk every morning, or there's other things that are keeping you busy in life, right? It's not going to be realistic for you to build a 3-hour long morning routine where you wake up and you go for a 2-mile jog and then you come back and you eat breakfast and you try to do all of this stuff exactly at the same time each and every day, right? People's lives get busy, and that's totally understandable, and so you should design your routine around that. So here's an example of what my routine is and how I've kind of developed it to be easy to follow and repeatable every single day. I'm showing all of these in Eastern time. I'm actually 2 hours back from that in Mountain time. So for me, the stock market opens at 7:30. But again, I'm showing these in Eastern time just to be clear. So I wake up pretty much every day, at least by 8:20 a.m. Eastern time. So about a full hour or a little bit more than an hour before the stock market opens. I prepare a light breakfast. Maybe I'll drink some coffee if I'm feeling particularly sluggish that day. And then I sit down at my desk by around 8:30, 8:40. Between 8:30 and 9 a.m., I'm choosing the stocks that I'm actually going to watch that day. And I'm creating my confluence levels, which we'll learn about in section 2 of this course. And I'm picking my trade plan and writing it out for each of my individual stocks. So by 9:30, so kind of the last 30 minutes, I have a fully written out trade plan for my stocks. I have my watch list, and I can reassess any of the levels if I need. So if there's kind of a large move, I'm not messing up my entire day. I am able to kind of readjust for that right before the market opens. And then finally, if I'm feeling a little bit stressed or a little bit frazzled that day, I'll actually do a short meditation if I feel like I need that. Most of the time, I'm pretty good about getting in the zone without it. But if life is a little bit hectic, I'll throw that in if needed. Finally, the stock market will open at 9:30. And I will typically trade until 11:30 Eastern time. I normally am done for the day prior to that. And if I'm not done for the day prior to that, something is potentially wrong, or there's been some economic news that has delayed my trading, whatever it is. But I'm trading my plan. After 11:30 through kind of the end of the day, I still will sit there and watch the market. Maybe I'll be in the Discord room chatting with other traders. But the first thing I'm going to do always after I've finished trading for the day is I'm going to journal and review my trades. So that's what a typical day looks like for me, and that's what my pre-market routine looks like. Okay, so now we're going to talk about a very important concept that is largely overlooked, particularly by new traders. This is pre-filtering your universe of stocks and assessing their pre-market interest. Each and every stock that you might consider adding to your watch list in the morning should pass these two checks. The first check is the Intraday Trading Quality Score, or ITQ score. This ensures that your stock is liquid enough to trade and has tradable intraday price action on a regular basis. So for my system, I take all the thousands of stocks that are out there and I filter it down to a list of roughly 80 to 100 stocks. And then in the morning, I choose out of this list of 80 to 100 stocks instead of having to think about trading, again, any of 1,000 tickers. To get to this list of 80 to 100 stocks, I assign these parameters and filter down. Now, this set of parameters might be slightly different for you if your strategy is different than mine, or if you like trading different floats of stocks. Maybe you're a low float stock trader. I'm definitely not, and so my parameters reflect that. So the first is that the float of the stock, which again is our rough estimation of liquidity, is 25 million shares or greater. I want low spread stocks, so I take less type 2 slippage, so I look for generally on average less than 10 cents. I want the average daily volume to have lots of shares traded, so I put this at greater than 10 million shares. I then want stocks that are, roughly in the $10 to $300 price range with a preference above $25. Again, this is how I trade. You might be very different from this. Finally, I look at the price action back through several days of trading, and I make sure that there are no gaps in intraday candles and there are clear, consistent moves. So once I've done that, I have a list of 80 to 100 stocks. Once I have that list, I do check number 2, and I look at pre-market interest, or the PI score. This ensures that the stock has a retail or institutional interest, and it confirms any importance of news catalysts or other big news events. So what I look for is in the pre-market, I want to have at least 300 shares traded. Okay, so I take this list of 80 to 100 stocks, I look at the ones that have greater than 300 shares traded, and I start to dig through those in more detail. I then look at the price action in the pre-market, and I want this to appear as close to intraday price action as possible. If you can't tell the difference between the stock during the pre-market and during the actual open, that's a good sign. It means there's tons of interest and a lot of people are actively trading it. So let's get into some examples of these two scores next. Okay, so once you've filtered down your intraday trading quality score based on the parameters that we talked about on the last slide, you're then going to start digging through those stocks and you're going to weed out the ones that look like they have very bad intraday price action on a regular basis. So here are two examples of very bad intraday trading quality. The first is ADT. You have kind of these, I call them robotic candles, where you're just moving, and these are 5-minute periods, you're just moving between 1 to 2 pennies up and down over and over again. Okay? This is terrible. Never trade stocks that look like this intraday. Okay? Notice how little volume is taking place and how bad this price action looks. On the flip side of that, or just another example, the other thing you're going to want to really watch out for is gaps in between your candles. So this is a 1-minute chart of ABB. Look at this price action. It is untradeable. You have one candle that literally basically didn't trade, followed by a giant gap, and another candle that, again, literally basically had no trades on it. It was just at that exact price point. So if you see either of these in your list of stocks, just throw them out and don't consider trading them ever, really, not even just that day. Just get rid of them altogether. But now let's look at some good examples, right, which you would want to see. And these are two names that you've probably heard of, Apple and Nvidia. So notice this 1-minute chart on Apple. One, you have tons of volume, right? You have 81,800 shares kind of maybe on average traded throughout this time frame. And each and every one of these candles is well formed. There are no gaps, just clear, consistent movement throughout. Okay? So that would be a good example if you were looking at intraday trading quality. Here's another example just to show you on a 5-minute chart. Once again, there are no gaps, clear volume throughout, clear consistent moves, right? You have a nice downtrend here, a reversal, and then a nice uptrend up. These are stocks that you can trade, okay? And when you get to, let's say you get to a list of 300 to 400 stocks with the first set of parameters, you then filter out the bad ones, and you're left with maybe 80 to 100 stocks like this. Okay, so now let's look at some examples of very bad and very good pre-market interest. So remember we said we've filtered based on ITQ, and we have our list of 80 to 100 stocks. Now I'm looking at stocks that I might want to trade that particular day. And we're looking for interest from retail and institutional investors in the pre-market. So here are some very bad examples of that. This gray area here is your pre-market. Notice how GE essentially has no volume and very gappy, choppy, weird price action, right? You have these little dash candles which represent basically no price movement during that time frame. This is something that you would want to avoid altogether, right? There's clearly no interest. And it might trade okay during the day, but there's no point in putting this on your watch list because obviously it's just going to move however it would normally move that day. There's no news catalyst, there's no event, there's no reason that you would expect good price action in the open. Here's another example on Snap. Once again, you look at a 5-minute chart, it gets okay closer to the market open, but prior to that, it's very bad. And if you were looking at this stock versus a stock with a very good PI score, you would just throw this one out. There's no point in taking a look at it. So here are some good examples of PI score. Here's the SPY on a 5-minute chart. If you look at this price action and it wasn't grayed out and I didn't show you the time, you wouldn't necessarily even be able to tell that this wasn't the open or wasn't the actual time frame. Okay, obviously the volume's low because you're in pre-market, but this trading, smoothness and overall quality is close enough to intraday price action that we can see that there's interest in the SPY. And the SPY maybe is an unfair example because it's pretty much always going to have interest on it since it's an ETF, but regardless, that's a good example. Here's an example on Walmart. Walmart's a stock that I think very rarely trades well. I wouldn't give it an overly high ITQ score, but when it does have news and when it does have institutional interest, it can trade very, very well. So normally, if you looked at Walmart in the pre-market, you would probably consider it a bad example like we talked about. But on this day, you can see, hey, again, you have a nice little uptrend here, very clear, smooth moves, no gaps or huge gaps in the candles. And, again, very low volume, but for Walmart in the pre-market, this volume's honestly not that bad. So this would be two examples of good PI scores where you would at least consider putting these on your watch list in the morning. Okay, so we've walked through good and bad examples of both ITQ scores and PI scores. So now we're going to get through how you actually develop your watch list. And these are the steps that I follow. I'm going to give you in a couple of slides a few different methodologies that you could use if this doesn't work for your style in particular. So the first thing we do is, once again, we've narrowed down stocks based on ITQ scores. We're looking at ones that have good PI scores. I'm now going to look for stocks that might have a news catalyst. And the way I'll do this is I'll first look at stocks that are gapping up or gapping down heavily because they might be doing that in response to a news catalyst. I will also consider sectors that are just generally hot at that time. So there was a time when electric vehicles were just, they were in play, they were tradable every single day for months at a time. So I'll look for anything like that. And then I will assess the quality of the news catalyst related to the stocks. But I will not gain a bias, okay? So even though a stock has really good news and is gapping up 10, 15%, that doesn't mean that it's not just going to then sell off for the entire day. The old adage is, buy the rumor, sell the news. And that is very, very true in trading. So anyways, I'm going to assess the quality of the catalyst and I'm going to assign it kind of either an optimal, average, or ignore score. Optimal catalysts in terms of news, in my opinion, are things like either earnings or company-specific news. So if, Bed Bath & Beyond announces that it's going to close a bunch of stores or it's reduced its guidance, that's a good reason to be in that stock trading it. An average catalyst would be like a halo event. So let's say AMD announced that it was going to have poor earnings. Nvidia might also trade down because it's a very, very similar company. Or things like broader sector impacts or just general economic news that's impacting an entire sector or the entire stock market. The ones I'm going to ignore are things like buyout announcements or analyst upgrades and downgrades. Analysts generally look at a longer term performance of a stock when they give it a buy, sell, whatever rating. I really don't care what they think because I'm only trying to trade that stock that single day. The fourth thing that I'm going to do is I'm going to choose stocks that will work well with my strategies based on where they are in their daily ranges. This is something that is covered heavily in section 2 of this course, so we're not going to really go into detail now. But you'll want to choose stocks that are in a range that will work with the strategies that you're trying to trade. The last option that you can do is you can actually join our Discord channel, which is linked in the description below, and you can talk with myself and other traders about what they're watching that day and why. So all of these steps you can use to come up with your final watch list. Now we'll move on to, some kind of potential other examples and examples of economic news. All right, so I want to show you a quick example of why you need to be keyed in on economic news prior to kind of finalizing your watch list for the day. So at the time of this presentation, we're in a period of very high inflation compared to what the historical average has been. The Fed has implemented a series of rate hikes to combat this inflation and try to bring it back down closer to 3%. The key point with economic news is that you need to understand how drastic the potential reaction could be and adjust your expectations accordingly. So right now, any reaction to a rate hike has been fairly dramatic, particularly around technology stocks. And you want to try to never be in a trade during these talks and trade sparingly prior to the announcement. But in terms of your pre-market routine, if the number is going to be released in the pre-market, you need to wait until after the announcement to choose your watch list and set your levels. And here's the reason for that, right? Here is the CPI number being released. So you can see it's fairly normal price action. And then right at 8:30, we get the number. You get this ridiculous sell-off and then basically just full rebound back up, okay? And it keeps going for several more candles. After this happens, all of your levels that you've drawn for the day are going to be completely useless because the market has just digested key information and is now making decisions based off of that. So anything you drew prior in terms of support and resistance, any plans you had for the day are now totally destroyed and you've wasted a lot of time. So just be careful with things like CPI number releases or other big economic news announcements and plan accordingly. And just for fun, real fast, I want to show you a live recording of what happened when that CPI number from the previous slide was released, just to highlight why you absolutely wouldn't want to be in a trade during these announcements. So let's say you're in a trade here long, and then boom, the CPI number releases, and immediately you've taken a horrible amount of slippage and you've gotten stopped out. And you can see, literally the second the announcement comes out, algos are reading that and making trade decisions off of it. There's no way that you could trade in this environment. And that's not really the point of this particular example, right? My point is that not only should you not have been trading here, which is obvious, I think, from watching the price action, but everything that you had planned for that day is now out the window. So just be careful around these economic news announcements, and I will move on. Okay, now we'll talk about some alternative methods for developing your watch list. I don't personally use these that often. However, I have used them in the past, and I would recommend them for certain types of traders. So if these resonate more with you, feel free to use them. Just pay attention to the pros and cons of the different methodologies. So the first methodology is the set watch list method. And this is trading only a single stock or a handful of stocks every single day. So you're trading the same set of stocks day in and day out. The pros of this methodology, other than obviously saving time because you know exactly what you're watching, are first that you learn the way that the stock moves. This can be very valuable because every stock does have its own quote-unquote personality type, and learning one stock can make you a better price action trader. Second, you are very connected to daily levels and specific news around this stock, right? If you're only watching one stock, you absolutely should be keyed in, but even if you're only choosing from, the same 4 stocks every day, you should be, once again, very honed in on what's going on with that stock. The cons, though, of this method are that you could suffer from choppy days more frequently, okay? And what I mean by this is that very rarely does a stock trade well every single day, okay? And, maybe you like playing choppy days. You just want to play the top and bottoms of ranges, and you're okay scalping very small moves. But for most people, you're going to find it very difficult to trade maybe a single stock each and every day. You're going to get just chopped out more days than you're going to have really fantastic moves. The second major con is that, maybe trading one single stock makes sense for a certain period of time when that sector or, that stock in particular is really hot. So an example of this could be NIO. NIO is an electric vehicle manufacturer out of China. And for months on end, it was considered kind of, it's the Tesla of China. It's this new hot stock. And you could have traded that stock every single day. And I did. I had it on my watch list for probably 3 months at a time. But eventually, it fell, quote unquote, out of play. The news around it dropped off. It wasn't as interesting. And its ITQ score that we talked about in the previous slides dropped off tremendously. And it became really choppy and really hard to trade for a very long period of time after that. So you just have to be careful that the stock you have chosen doesn't kind of fall to an untradeable level. The next method is the scanner only method. This is one that I would personally recommend the least. Like I would do this set watch list method before I did this. And basically what this method is scanning the market using a software like Trade Ideas, which you can go look up. It is a fantastic software, but you're scanning the market actively looking for a set of criteria. And when your criteria hits, these stocks will pop up on your Trade Ideas window, and you'll be able to go to them and know that all of your criteria is in place. And so that's really the major pro of this method, is that if you can set the scanner up properly to basically say, I want it to scan based on all of the rules that I have for my strategy, then this can help you follow your rules. Because if it pops up on your scanner, you know that it meets your criteria for a trade. So that's the major pro. However, it comes with several cons. The first is that Trade Ideas and other scanning software can be very expensive. There are other options out there. You're free to explore and Google and look around, but for the most part, it's expensive. Second, it can make trading very difficult in terms of trading your plan, and that's a big thing that I try to teach in this course. And if you don't know the stocks that you might be trading that day until they pop up on your scanner, then your plan is not going to be very prepared. And this might just lead to you kind of panic entering trades and FOMOing and other things. The third major con is that this can be analysis paralysis. If your scanner is not that tight in terms of the parameters and you're getting, 10 to 15 different alerts every 5 to 10 minutes, then, again, you could just become overwhelmed and you're trying to click through all these different options. You're taking too many trades. I've just seen it be more crippling than it is helpful in the past. So those are 2 different methods that you can use if the method I talked about in the previous slides doesn't resonate with you as much. And now we'll move on. The last thing that I want to talk about in this lesson is planning your trade and trading your plan. This is a critical skill set to learn because it's going to give you 2 super important benefits. It's going to give you patience and it's going to give you trust in your system. So, once you've chosen your stocks for the day, I want you to write out a simple trade plan and keep it up on one of your monitors and reference it before you enter trades. So This does not have to be super detailed, okay? And honestly, the longer that you trade and the more years of experience, the less you're going to specifically need to write it out. So let's look at an example. Let's say I'm trading Apple. And on this particular day, I have identified key levels as my Camaria pivot points, R3 and S3, which we talked about in lesson 1.5. I've written out my setup. So I say I'm going to wait for a sell-off to S3 for a reversal signal to form. I'm then going to go long, and I'm going to target previous day close, and then I'm going to leave a runner on for a final all-out at R3. Think about the level of patience that this gives you, particularly as a new trader transitioning from sim trading to live trading, because there's a ton of emotion involved. There's a huge temptation to FOMO trade and overtrade, but by writing this trade plan out, you give yourself a level of discipline and patience that you otherwise might not be able to achieve, okay? Because you are looking at Apple in the morning and you're watching it go up and down and trade, and if this doesn't happen, if your setup doesn't take place, then you simply don't take a trade. And you have other trade plans on 4 or 5 other stocks that you're watching that you can trade instead. So point number 1 gives you a ton of patience. Point number 2, it's going to give you trust in your system. And to highlight this, I want to talk about journaling. And we're going to talk in great detail about journaling in section 2 of this course. But for now, what I want you to do is include a note or a grade in your journal specifically related to whether or not you followed your original plan. And so let's say on days where you go back and you look, let's say over a month or 2 months of data, and on days where you followed your plan, you had a 55 or 60% win rate, and you were green. And on the days where you did not follow your plan, you had a 20% win rate. Well, then clearly your plan is working, your system and your strategies are working, and that should increase the level of discipline and conviction that you have in following your system. So planning the trade and trading your plan is an extremely valuable skill set that all traders should use. Okay, so that brings us to the end of our lesson on finding stocks to trade and morning prep. I've got just a couple of quick closing comments as always. The first one is that you need to find a pre-market routine that puts you in the zone. This is going to be different for everybody, but it really allows you to be successful in your trading. Second, remember that everyone trades differently. So over time, you're going to develop your own unique style, and you're going to have to find a morning routine that you can do that fits your style. Finally, remember to set up and trade your plan each and every day. If you don't do this, then you lose the ability to be objective when you're evaluating your performance and the performance of your trading system. So with that, we'll end today's course. I hope you found it helpful, and I'll see you in the next one.